Log on to our website at dialectradio.co.uk to find out more.
My name's Ian Fraser. I'm a financial journalist and I'm the author of Shredded, Inside RBS, the bank that broke Britain, which came out in a new edition in May 2019, which we already called last year. And basically, Andrew Bailey's someone, who's figured quite prominently in my consciousness over the past 3 years, because he took over as chief executive of the Financial Conduct Authority in, I think it was July 2016. And as you know, he's just been announced that he will be succeeding Mark Carney as the governor of the Bank of England.
Could you tell us, how long he's been at the FSA? And maybe we could start by just, what is the FSA? Because it's got a very big responsibility, hasn't it, for making sure that the British financial sector is safe and sound. And we know, don't we, there's a lot of challenges to that, particularly since 2008.
Yeah. Well, it's basically got a, pretty unfortunate history. It was originally called the FSA, or Financial Services Authority, when it was founded by Gordon Brown in 1997. And then, it was shown to have really failed as an institution in October 2008, when most of the British banks had to be rescued in one way or another.
Yeah, but hang on. What about before that, though, Ian? I mean, surely there was somebody keeping an eye on the banks. Was it Scotland Yard before Gordon Brown brought in the FSA?
No, it was the Bank of England. The Bank of England was the main supervisor for the banking sector until 97, when Gordon Brown removed the supervision of banks away from the Bank of England and set up this new body, which was partly drawn from the Bank of England because the people who did it at the Bank of England were moved across to the FSA, and it became fully functional in 2001. There were a range of other regulators introduced at the time of Big Bang under Thatcher, which looked at various things, various aspects of the financial services sector. So there was, one for insurance, one for fund management, one for banks, which was the Bank of England. And so it was a much more fragmented way of looking at regulation prior to the creation of the FSA.
Well, look, one of the major problems we've seen is auditors. For example, the HBOS, which some say, made a great big contribution to the financial crisis and the bailouts in 2008. Yeah. So what about the auditors? Who looks at them?
Well, nobody really. They're sort of they're self-regulated because originally it was by the various chartered accountancy institutes like ICAS in Scotland or like ICAEW in England and Wales, and these were what's called self-regulatory organisations. So it's like profession of the accountancy profession regulating itself. There was a separate body that came in called the Financial Reporting Council. But this has always been very weak and hasn't actually been particularly, it's been kind of captured, is the jargon, by the accountancy profession. So this body, the FRC, was certainly very ineffective in monitoring audit quality and monitoring potential corruption or mismanagement within the audit sector.
Okay, so what was the thinking behind getting rid of the FSA and bringing in this Financial Conduct Authority that we've got now, that Andrew Bailey's in charge of?
Okay, well, this was a brainwave of George Osborne, and it was the so-called Twin Peaks model of financial regulation. I think Adair Turner, who ran the FSA towards the end of its life, was also one of the brains behind this idea. And what you have is you separate out what's called the macro-prudential aspect, which is looking at broad issues within financial markets, capital ratios within banks, capital strength of banks, liquidity in the system. So there's a broad brush stuff to do with financial markets and financial strength of financial institutions. Was to be looked after by a new body to be founded in April 2013 called the Prudential Regulation Authority. And actually, Andrew Bailey was the inaugural chief exec of that body, which sits within the Bank of England. And the separate part, which is the more kind of nitty-gritty stuff of, are individual people within the financial world behaving badly? Are they ripping off their customers? Are they, nicking money, or whatever you want to call it, which is broadly called conduct. That came under the aegis of the new body, the Financial Conduct Authority, whose initial head was a guy called Martin Wheatley, who was fired by George Osborne a couple of years later. So you had this split, which was really a Tory idea, of macroprudential into the new Prudential Regulation Authority, or PRA, and you had the microprudential, which is basically conduct and checking people aren't misbehaving, into the new Financial Conduct Authority.
Okay, so in the background to all of this, there was the fallout from 2008, where it was rather a different split was recommended by many people involved, including Andrew Tyree, saying, actually, what we really need is a split between what they call casino banking, that is, say, investment banking, and the high street banking. Is there any sort of idea still in the regulation at the City that this is a good idea? Because that seemed to me to be the most important message that came out of 2008, if they don't want it to happen again.
Well, that was not so much on the regulation side. That was more on the actual structure of the industry side. And that's what basically happened in the US in 1933 when they passed the Glass-Steagall Act. After all the corruption and scandals that became apparent after the Wall Street crash of 1929, and they separated out all the stuff that would be worthy of receipt of a government bailout if it failed, because it involved customers individual consumers potentially losing their deposits. But basically, that was a split which was very effective in the US for 70 odd years. Or more like 50 odd years, actually, which involved splitting the casino banking side, which is investment banks trading on their own account, from the more mundane day-to-day banking of actually servicing customers and small businesses and medium-sized businesses on the high street. The former would not qualify for any government bailouts. Therefore, the players in that industry would be doing it at their own risk, whereas the players in the utility side, the high street banking, would be protected and would qualify for government bailouts in the event of their institutions failing. So this was a split, which there was an original banking review set up by Cameron's government in 2010, and I think it was something like the Independent Commission on Banking, something like that. And that did recommend something called a ring, rather than a full split, it recommended something called a ring fence within institutions, so that the one part would qualify for bailouts and could trade at its own risk, and that a more kind of socially valuable side of the business, which is the retail and high street banking, would be separated on the other side of the ring fence and would qualify potentially for bailouts if it failed.
So what do you think, Ian? Was that a fudge? Were they fudging there at that point?
Well, I mean, it was called the Vickers Review. It was a guy called Sir John Vickers, who's a professor at Cambridge, I think. And I think what they did come up with was a bit of a fudge, to be honest, because if either you want to split these things or you don't, and just to go for sort of an internal ring fence, which is potentially very porous, isn't necessarily going to resolve any problems long term.
Let's get back to Andrew Bailey and the Financial Conduct Authority. What's his track record been like there? Because he's now the main man. He's now taking over from Mark Carney at the Bank of England. Yes.
Well, I would argue that in his early days, from April 2013 until July 2015, when he was the inaugural chief executive of the Prudential Regulation Authority, or PRA, he did a reasonably good job. That was a new organization, and it was pretty tough. It was hard on banks whose capital ratios were inadequate. And, one might argue that he failed over Cooperative Bank in that role. But generally, I would argue within the confines of the role that he was given, from 2013 till 2015, so just over 2 years, he did a reasonably good job. Then he became the second head of the FCA, the Financial Conduct Authority. That was after the Chancellor, George Osborne, fired his predecessor for being too tough on the banks in July 2015. And actually, in my view, his track record as CEO of the Financial Conduct Authority has been pretty disastrous. One of the areas that I'm most familiar with is the RBS Global Restructuring Group story. And it seems, that he's basically tried to sort of to minimize, to downplay or minimize the extent of the problem, to misrepresent the findings of an organization called Promontory, which was asked to do an independent report into GRG by the FCA. And there's absolutely no doubt that Bailey misrepresented the findings.
I mean, for those that aren't familiar with it, Ian, what was GRG up to?
Global Restructuring Group was part of Royal Bank of Scotland, NatWest, and Ulster Bank, which is all one bank under the RBS plc banner. The main period when GRG was active was 2009 to 2013. And in that period, it essentially massacred up to 16,000 UK businesses, which were mainly within the small and medium-sized enterprise category. A lot of business people who had kind of worked for decades to build up a business suddenly found that the business was destroyed, willfully destroyed, by Global Restructuring Group, which was part of RBS Group. There were various ways in which this happened, things like deliberate misvaluation of assets, including properties, removal of facilities, and sudden charging of far higher fees and interest rates than had been agreed to by the customer. There were various methods by which Royal Bank of Scotland and its subsidiary banks, NatWest and Ulster Bank, deliberately set about seizing assets from their own business customers, often through very Machiavellian and underhand means. And Global Restructuring Group was the part of all these banks that did this.
We've come across a story here in Bristol, which sounds very similar actually, but it's attached to Lloyds Bank, something called the Business Support Unit, BSU, based in Castle Park here in Bristol, which I noticed recently that Noel Edmonds has managed to claim a multi-million pounds apparently from an out-of-court settlement. So it does seem as if this maybe wasn't just RBS NatWest, that Lloyds and other banks may have been doing this too.
Certainly, there is evidence to suggest that a number of British banks were doing very similar sorts of things, and Lloyds Banking Group, which obviously includes Bank of Scotland and Halifax, as well as Lloyds Bank, was certainly doing something similar. Clydesdale Bank has been accused of the same sorts of practices. Barclays Bank has to a lesser extent, as has HSBC to a lesser extent. So one might argue that they were all up to it to one degree or another. There haven't been any criminal cases yet, so you can't say whether or not there's been criminal behaviour or not. But certainly there is seriously unethical behaviour, and there is how else would you put it? I mean, it basically has destroyed trust in the banking sector. If your bank, which is supposed to be helping you, suddenly becomes a mafiosi type figure out to destroy your company and seize your assets, it does completely undermine confidence in the banking sector.
But surely that's not very good. Surely that's not very good for the bank either. I mean, they want you to be a thriving business, giving a good return on the loans that they've taken out.
Well, you'd have thought so, but for particular reasons to do with Basel capital rules and to do with the plight in which banks found themselves after the crash of 2008, and the fact that the bailouts that Gordon Brown orchestrated in October of 2008 were inadequate to see the banks through, they all indulged in this sort of behaviour, and it in my view has been absolutely catastrophic for levels of trust in the banking sector. So
the idea really was to asset strip all businesses that they could in order to back up, to turn everything effectively into a kind of cash reserve at the bank, because the banks didn't have enough.
Yeah. Well, in Ireland, I think every single SME customer of Ulster Bank was put into GRG willy-nilly, irrespective of its financial health. So, yeah, it's a short-sighted tactic that some banks, worse than others, seem to have taken in the aftermath of the 2008 crisis. In terms of Andrew Bailey's role, I mean, just one example. On 8th of October 2016, he came out with what was called a high-level summary of Promontory's findings. And by the way, Promontory is basically a large consultancy based in the States, which had been asked to investigate this matter by Bailey, or by Bailey's predecessor, sorry, at the FCA. And he said in the summary, the Financial Conduct Authority claimed they'd only found a few isolated examples of poor practice, which is hugely misleading and doesn't in any way represent what the Promontory report found, that the malpractice and the mistreatment of SMEs was widespread and systematic. It's the inverse of what they actually found. So this is just one example of how Bailey, I think, failed to handle this situation very well. He appears to have deliberately misrepresented what had been found by the organisation he had tasked to investigate the matter had found.
It does seem as if there may have been thousands of viable business destroyed by this method.
Yeah, well, I think that there is one of the figures that I've seen is 16,000 small and medium-sized enterprises were put into GRG. And of those, I think fewer than 5% emerged alive.
Incredible. What else, other financial scandals, has Andrew Bailey been doggedly looking into as part of his role at the FCA?
Well, I mean, the ones that certainly stand out are London and Capital Finance, which involved 11,500 people losing a combined £237 million. Now, the organisation was selling things called mini bonds, and I'll call it LCF for short rather than London Capital Finance, and it was bragging about the fact it was FCA approved, even though what it was doing in terms of selling mini bonds was unregulated activity and therefore not covered by the FCA. And these bonds were promising returns of up to 9%. But basically, it seems to be a very questionable outfit, seems to have basically been a Ponzi scheme. And the four main executives within it seem to have basically funneled out the cash from LCF, which was being put in by investors to fund their own lifestyle projects. One of Bailey's problems is that regulation is so sort of disjointed in the UK. You can have an entity like the entity London Capital and Finance, which is regulated by the FCA, but what it actually does, which is sell mini bonds, is not regulated by the FCA. It's very misleading for savers or consumers because they see the fact that the entity is regulated by the FCA and they think that provides some sort of reassurance. But in reality, they're given very little reassurance at all when the thing goes tits up.
Well, no, that's £237 million down the drain, although, of course, that money has gone somewhere. But the main point surely there is it's not the FCA's fault if somebody like the LCF is using their name when they shouldn't be.
No, it's not. So, in the case of London Capital and Finance, or LCF, it's difficult to know at this stage how much one can blame Bailey or the FCA as an organisation, or whether you can actually blame the structure of regulation and the fact that, it's so disjointed. But certainly someone has ended up with roughly £237 million of investors' cash, and a lot of it does seem to have ended up in projects run by the founders, who I won't name. I can give you the names if you want. But,
please do. Yeah, and that's no problem with
okay.
that.
Yeah, well, it's Rupert Hume Kendall and Andy Thompson, who were two of the top guys, and then Elton Barker and Spencer Golding, who between them trousered nearly 12 million in the run-up to the collapse of the company and used LCF funds to bankroll their own ventures. As I said, it was effectively a Ponzi scheme.
Does that mean that their own ventures are still going? Because one would have thought that in a case like that those ventures would have been closed down and all of the remaining resources would have been given back to the original investors.
In this instance, it does seem as if Smith and Williamson, who are the administrators of LCF, are doing a pretty comprehensive job, and they are putting some of the ventures into administration and seizing whatever they can back in order to ensure that the LCF investors aren't left completely penniless.
What about one of our local funds here, which is managed through Hargreaves Lansdown? That is the Neil Woodford Fund. Now, some estimate as much as £1 billion has been lost from investors there. And in fact, in The Guardian back in November 2019, we heard that there could be another £1 billion could be lost.
Yeah, well, the Woodford Equity Income Fund was managed by a guy called Neil Woodford, who came out of Invesco Perpetual, which was a Henley-based fund manager. I mean, again, I don't necessarily think there's been any deliberate criminal behaviour on the part of Neil Woodford, but it's basically one of these stories where someone emerges as a so-called star manager. And someone like Hargreaves Lansdown, which is, I think, the UK's largest IFA now, basically decides that he is a star, but doesn't bother to properly monitor what he's up to. And so they channel as much as they can of their own customers' funds into his funds, and don't properly look under the hood as to what he's actually doing with the money. And in this instance, he made some incredibly poor investment decisions. And he also invested quite heavily in so-called illiquid stocks, which are ones that you can't buy, or shares that you cannot buy or sell easily because they're unquoted. And I think those figures that you mentioned could well be accurate. That the investors in this particular fund, the Woodford Equity Income Fund, could lose, I think, around about 1/3 of what they put in. It is currently closed. It was closed in June or suspended, so no one was able to get any money out from 6th of June, I think it was, 2019. And it's currently being liquidated. So all the holdings are being sold in one way or another in the hope that investors can get as much as they can back. But I mean, I think in this instance, it does look like Bailey was asleep at the wheel. He should have been doing more. This was one of the most prominent mutual funds in the UK. And, it doesn't look like he or the FCA was doing nearly enough to monitor where Neil Woodford was investing the money. And, there were various red flags that they should have been aware of. For example, Woodford set up his business in 2015, and within 2 months, he'd fired his compliance director. Things like that, should have been noticed, I think, by the FCA, and they should have been investigating it.
So what sort of governor do you think Bailey will make? What will characterise this role? Because it's actually a very, very important role at the Bank of England, isn't it, Ian? It could really make an enormous amount of difference as to whereabouts the investment goes. Because we've seen, for example, with people like Richard Murphy and his idea, which is people's QE, that the bank, obviously, would have to be guided by Sajid Javid in the Treasury, but it could be investing in all sorts of things like public housing. It could be investing in, for example, it could be giving more money to the government so that they could do something like make much more money available for public sector investment of the government. They could even come up with the citizens' income. If the bank was with the right kind of person at the helm, lots and lots of things could change. And I wonder what you think. What do you think? What kind of governor do you think he's going to be compared to Carney or compared to Mervyn King before Carney?
Okay. Well, I think those are all very interesting ideas, the ones that you've just mentioned. But personally, I don't think they're going to be on. I don't think they're going to be on Andrew Bailey's agenda as the governor of the Bank of England. I think basically, Johnson's government made this appointment. When was it actually announced? It was announced after the 12th of December, wasn't it?
Just after the general election.
Yeah. So, Johnson's government is not going to be particularly adventurous where the financial sector is concerned. Bailey is very much a creature of the existing establishment within finance and within the Bank of England, where he spent most of his career, because he was in the Bank of England before. I mean, I didn't mention it at the beginning, but he was in '95. He was the private secretary of the Bank of England Governor Eddie George during the Barings crisis, for example. So he's essentially a Bank of England lifer, and he's not a particularly creative thinker. in my view. He's seen as what's called a safe pair of hands, i.e. don't rock the boat. And so the idea that he will actually, embark on any radical transformation of the Bank of England, I think is extremely unlikely. I think he's probably very close to the banks, and his time at the FCA, where he has been chief exec for 3 years, suggests that his priority is not necessarily the interests of consumers or the interests of small businesses, but it's the interests of protecting the banking sector. Arguably that's what he's been doing with GRG. That's what he's been doing with various other situations in relation to banks. So, sadly, I don't think he's going to be a reforming governor.
Most of the press, the financial journalists seem to almost as one have said, oh, well, this guy's going to be a safe pair of hands, the right person for the job. And generally speaking, he's got a lot of pats on the back. Why do you think that might be?
There have been some articles which have questioned his suitability because of things like we've just mentioned, including GRG, LCF, Woodford, etc. There have been one or two articles which have, said, this is not the right guy for the job. This is a guy who's clearly either incompetent or too close to the banks. But you're right, there's been a lot of coverage saying, well, hey, what a great appointment. And to be honest with you, I don't really fully understand why that has been. It seems like a lot of the financial journalists in the UK, particularly on titles such as the Daily Telegraph and possibly on the FT, they turn a blind eye to a lot of the problems that exist within the financial sector and a lot of the misdemeanors and crimes that happen in the financial sector. And it may be to do with, what I've called access journalism, i.e. they want access to the chief execs of those banks or the boards of those banks, and they don't want to again, perhaps a bit like Bailey, they don't want to rock the boat too much. So maybe they just think, Bailey's going to be great and, he'll be a fantastic governor of the Bank of England. I certainly don't share that view.
Also, we're saying goodbye to Mark Carney. How well do you think he's done?
He does seem to have a lot of critics who think, he's not been a very good Bank of England governor. And I suppose, certainly on the Brexit thing, he's alienated a lot of people who are pro-Brexit. Some of the more kind of Eurosceptic or Europhobic MPs absolutely loathe Mark Carney because he's seen as basically, he's been seen as someone who's almost tried to ensure Brexit doesn't happen. Personally, I think he's been all right. I mean, there's various blots on his copybook, like, what was it, something guidance? I can't actually remember the term, but there's something guidance he introduced early on, which was meant to be, he was going to basically give a foretaste of where interest rates were going to go. That failed, obviously. But I mean, things like, for example, that he has been campaigning on climate change and wanting climate change to be much more widely considered, impact of investments on the environment, on the climate, to be much more widely considered within the financial sector, are good initiatives as far as I'm concerned. So overall, I'd say, I'd probably give him about 6 or 7 out of 10.
Okay. Now, we could go back even further to Mervyn King. He said recently on the Daily Mail's website, This Is Money, which is a sort of subsection of the Mail, that there is a £166 trillion debt overhang. Now, that is including things like derivatives in there, and he's saying basically the whole situation that led to the 2008 crash, Mervyn King is saying, well, it could all happen again. In fact, next time it could be far worse.
Yeah, I recently did a bigger piece on all that, and there are real worries. So, if this is the case, then Carney's record isn't as good as one might wish it to be. There are signs that the amount of debt in the system is actually now far greater than it was even in 07-08, which was when we had a debt-fueled crisis, global financial crisis. So, there are some real fears that not enough has been done to rein in borrowing or to rein in credit issuance or to rein in complex financial instruments in over the past 11 years. And in that, if that is the case, which it quite probably is, then maybe Carney does deserve more criticism than I gave him.
What about QE? Has QE actually solved any of these problems? Because that's their big solution. It's the only solution, it seems.
Yeah, well, yeah. When you've already got interest rates at near zero, you can't cut them any further to stimulate the economy, obviously. So QE was the instrument that was favoured by central banks around the world in the aftermath of the '08 crisis to try and get the economy moving again. And it has worked to varying degrees. But it's also, I can't remember the numbers, but it certainly enabled the top 10% in Britain to become a lot wealthier than they would have done without it. Whereas the bottom 80%, 90%, I think, are worse off as a consequence. So, it's meant to stimulate investment, but in some ways it's actually just helped those who have investment. It's helped people who have lots of investments in stocks and shares, or who had lots of investments in other vehicles, to basically get richer, because it's propped up the valuations of those the underlying assets.
Yes, it seems to prop up the prices of shares and property, that sort of thing,
yeah.
Which obviously most ordinary people can't even afford to pay the rent, let alone have some sort of investment in that. But anyway, if you can just round off, Ian, by telling us how we can follow you online and whereabouts we can read some of your newspaper articles.
Okay. Well, you can follow me on Twitter at Ian_Fraser. You can see my website at ianfraser.org, www.ianfraser.org. And, in terms of newspapers, most of the links are on their website, or there's also something called Raconteur, where you can also see a profile page to see some of my most recent articles.
Your book is called Shredded. Most people wouldn't buy a book about a bank because they would find it too boring. They probably want to buy a novel or something like that. But what would you say to persuade people that actually it's quite important to understand how these bankers operate?
Well, people have said it reads like a thriller. And I tried to lift the lid on what actually happens inside a bank at a high level. And this was by far the largest bank in the UK. And it was the largest in the world, indeed, between '07 and '08. Its collapse in October '08 is still affecting us to one degree or another, in terms of real wages being below the level they were at the time of its collapse in 2008. Interesting to read, because there are some real characters in there, like Fred Goodwin, who was the person who ran it up until he was kicked out in October '08. A real prima donna of the banking sector, egotistical and narcissistic. It combines a sort of, story of hubris, of someone who thinks he can walk on water, but then, the fallout of that in terms of what the government had to do to try and pick up the pieces, and, the 11-year battle they've had to try to restore the bank to sustainability. I do think it's a very interesting read.
I mean, over in Iran, they execute bankers that break the law. Do you think it would make a difference if they had something similar over in the UK? Because we don't really seem to see bankers going to jail, even.
Well, we don't, and I think this is a key problem. We have these things called deferred prosecution agreements, or DPAs, and basically that's where the shareholders are stung. They can pay, say, $5 billion was one of the more recent ones that RBS had, to extricate the bank from criminal proceedings in the US. And, that's great for the people who run the bank and the people who were running the individual parts of the bank that committed the alleged crimes. But it's the trouble is it doesn't change behavior. So, my personal view is if there is a serious high-level crime suspected within a bank, then it's up to the prosecutorial agencies, which in this country is the CPS mainly, and the SFO, Serious Fraud Office, to bring those guys to book, or at least try to just not bother and accept a sort of ex gratia payment, which is indirectly channeled from the shareholders, just seems totally wrong, because that's never going to change behavior. as long as these huge fines are just meted out in exchange for criminal prosecutions, you end up with a corrupt system, and you end up with a situation where the bankers basically think they can get away with it.
Okay, Ian Fraser, thanks very much for joining us.
Okay.
Well, that's all for this week. Dialects, Bristol's first weekly MP3 podcast. You can download it to listen on your phone or in the car. Suggest interviewees, subscribe to our email list and listen the week before broadcast if you like at our website dialectradio.co.uk. Thanks to our guests James Garrett, Ian Fraser and also studio engineer Dave Bazanko. Dialects, a Bristol Broadband Co-op production. Catch us on Bristol Community FM 93.2 every Tuesday at noon, and anyone can contribute. Contact us through the People's Republic of Stokes Croft, just off Jamaica Street. They're online at prsc.org.uk. Phone number 0117 909 6897. If you have some of your precious time to spare, you can volunteer with us or for hundreds of opportunities elsewhere in Britain via the National Volunteering website, do-it.org. So thanks for listening to Dialect, and I'm Tony Gosling wishing you a very good week. I'll be back on Friday with my 2-hour BCFM politics show, live from 6 till 8 p.m. Meanwhile, till next Tuesday, midday, from the Dialect crew, goodbye for now.